Welcome to the Deep Dive. We are cutting through all the noise of earnings season to pull out the signals that really matter for you.
And today we are tearing into the Q3 fiscal 2025 earnings call for Albertsons companies, ticker ACI.
Yeah, this one covers the 12 weeks that ended back on November 29th, 2025.
And our mission for you today is, I think, pretty essential. We need to synthesize the headline numbers, but more importantly, we have to unpack the strategic story they're telling.
Right, and then figure out why the market reacted so negatively despite some pretty solid operational wins.
Exactly. It's all about those competitive and policy headwinds that just spooked investors.
So you have to start with the numbers, right? And it was a classic mixed bag here.
Yeah, absolutely. The bottom line, it looked pretty good.
Yeah, adjusted earnings per share came in at 72 cents a share.
Which was a solid beat. I think consensus was around, 67, 68 cents?
Exactly. Oh. So a nice surprise there. But then you get to the top line.
And that's where you see the first hint of anxiety. Revenue was $19.12 billion.
A slight miss. The street was looking for something closer to $19.17 billion.
And identical sales, the key metric, came in at plus 2.4%. Respectable, but not exactly lighting the world on fire.
So an EPS beat and everything else is just fine.
Yeah.
And yet the market's verdict was just immediate and brutal.
Oh, yeah. The stock finished the day down almost 6%, 5.89 to be exact. Wiped out a lot of recent gains.
That's sharp a decline. I mean, that's the tell, isn't it?
It's the absolute giveaway. It tells you the market just completely ignored the earnings beat for this quarter.
And focused entirely on the future.
100%. It was all about the narrowed guidance and, crucially, their very detailed warnings about external risks that are, mostly outside of their control.
So the narrative of what's coming just completely overshadowed the reality of what just happened.
It almost always does.
Okay, so let's unpack that operational story. Because if you dig in, underneath the headlines, the company's transformation is actually gaining some serious traction.
Oh, absolutely. I mean, let's just start with digital. It's the powerhouse.
Up 21% year over year.
21%. And that pushed their total penetration up to 9.5%.
Which is a huge number. And it's all being driven by their loyalty program.
Right. The loyalty membership grew 12%. They're at nearly 50 million members now. 49.8 million. That's their whole customers for life strategy paying off right there in the numbers.
And the thing that stood out to me was the why. They gave numbers on why this matters so much.
You're talking about the grocery and pharmacy crossover.
Yeah. Customers who use both have a lifetime value that is just. It's staggeringly higher. They're estimating 4 to 5 times higher for the most engaged people.
I mean, that's a massive incentive. It proves they're not just selling groceries anymore. They're building a sticky ecosystem.
And they have the fulfillment to back it up. That's key.
It is. Over half of all their digital orders are delivered in 3 hours or less.
And the flash delivery. 95% of households are eligible for 30-minute delivery. In a fight with Amazon, that kind of speed is your weapon.
So digital is the foundation. But what's the engine driving it? Because the real strategic story they hammered home this quarter was the tech.
The AI narrative.
Exactly. The AI and tech narrative led by CEO Susan Morris. They're framing this as a step change for the company.
Not just little improvements.
No, a fundamental rewiring.
Well,
and they're leaning on big partnerships to do it. Google, OpenAI, Databricks. They're making a huge bet on technology.
And they have results. It's not just talk. They brought up the Ask AI search feature.
I love this example. For people who actually use it, they are seeing basket sizes lift by about 10%.
Think about that. That's not some back-end supply chain thing. That is AI actively changing how people shop and adding money to the register right at the search bar.
And when you have almost 50 million loyalty members, scaling a feature with a 10% lift is a direct lever for huge revenue upside.
Right, and that's just one piece of it. They laid out 4 pillars for this whole transformation.
Yeah, it's a comprehensive plan. First is that digital customer experience we just talked about.
Ask AI, personalized stuff.
Second, merchandising intelligence. Using AI to optimize pricing, promos, what's on the shelf.
Third is labor management.
This is where the generative AI comes in. Forecasting, scheduling, making sure you have the right people on the floor at the right time.
And fourth, the supply chain. Using AI for demand forecasting to keep shelves stocked.
And this all rolls up to the big number, the one that, should really matter to investors.
The $1.5 billion productivity target.
$1.5 billion in gains over the next 3 fiscal years. That is a massive, massive target.
It is aggressive. But achieving that kind of change, I mean, it comes with huge execution risks, doesn't it? Did they talk about any of the potential roadblocks?
They approached it with a lot of conviction. They basically pointed to the results this quarter as the proof that the engine is already starting to work.
So let's look at those margin numbers because there's some nuance there.
There is. Gross margin was actually down 55 basis points to 27.4%.
And that was because of the shift to digital and pharmacy, which have lower margins. Plus, they're investing in price to stay competitive.
But, and this is the big but, look at their SG&A, their operating costs.
Selling, general, and administrative.
Right. That rate improved by 33 basis points.
Okay, so for our listeners who might not live and breathe this stuff, what does that SG&A leverage actually mean?
It's pretty simple. It means your operating costs, labor, rent, overhead are growing slower than your sales. So even while they're spending all this money on AI and tech, they're becoming so efficient that more of each dollar of revenue is dropping to the bottom line.
So that 33 basis point improvement is the proof. The AI cost cutting is already working and paying for itself.
It's the clearest sign you could ask for.
We should also quickly touch on pharmacy because that was another bright spot.
It was strong. Sales were up 18%, driven by immunizations, prescriptions, and of course,
The GLP-1s.
the GLP-1 weight loss drugs. They're a huge driver. And management sees that continuing, especially as the pill versions become more common.
A future catalyst then.
A top-line catalyst for sure. They were careful to say they don't expect it to materially help EBITDA in the short term just because of how drug pricing works.
Okay, so phenomenal internal execution. Real SG&A leverage. A credible path to $1.5 billion in savings. If all of that is true, why did the stock get crushed?
And that's the multi-billion-dollar question, isn't it? This is where the company's internal story just completely diverges from the market's external fear.
And that fear started with competitive pressure.
Yeah, they were very direct about it. They said the promotional environment, especially over the holidays, was much more aggressive. Bigger competitors are using price as a weapon.
But Albertsons is fighting back. They're using what they call surgical price investments.
And it seems to be working. They said in the categories where they invested, they saw unit trends improve, in some cases moving back to positive, so they're defending their turf.
But that defense costs margin points.
Exactly. And on top of that, you have the consumer who is clearly softening.
And they said it was across all income levels.
It was. The details were concerning. Low-end shoppers are making smaller, more frequent trips for just essentials. But the real warning sign was the middle-income households.
The trade-down behavior.
Yep. They use the example of people buying ground beef instead of steak. That's a classic sign that financial strain is moving up the income ladder.
Okay, but the single biggest driver, the thing that really seemed to dominate the narrative was the policy headwind. The Inflation Reduction Act, the IRA.
This is a bit technical, but it is absolutely critical to understanding the stock's reaction. The IRA's Medicare drug price negotiations took effect January 1st, 2026.
And for a huge pharmacy like Albertsons, that has an immediate impact.
A huge impact on the top line. Management said for Q4, it's going to be a 65 to 70 basis point headwind to identical sales.
Wow. 65 basis points is a massive drag. No wonder the market panicked.
It is, but this is the crucial part that I think the market is missing. They were crystal clear. While it hurts the reported sales number, the impact to actual profit to adjusted EBITDA is expected to be near neutral.
Okay, break that down. How can a huge sales hit be profit neutral?
So think of it this way. The government negotiates a lower price for a drug. That lowers the total dollar amount that Albertsons reports as a sale.
Okay.
But Albertsons never made a profit on that price difference anyway, so they lose a nominal sale dollar, but they keep the exact same margin dollar. It's an optical problem that makes their sales growth look worse, but it doesn't actually hurt their profitability.
Which makes the 6% sell-off seem kind of irrational,
Right.
But they also said this headwind is going to get worse.
They did. For the full fiscal year 2026, they think the hit to comp sales could be as high as 125 basis points. That's a monster and an artificial headwind to grow against.
So all of this, the competition, the soft consumer, the giant IRA headwind, it all led to the guidance update.
Which was the trigger for the sell-off. They narrowed the full year outlook. Identical sales to between 2.2 and 2.5%, and adjusted EPS between 208 and 216.
And that narrow range, combined with all the warnings about external factors, was just too much for the market to stomach.
The market hates uncertainty. and they just injected a whole lot of it.
On the capital front, things look disciplined. They have the $750 million share buyback program still going.
And they're cleaning up the portfolio. They closed 16 underperforming stores and said they're looking at all their non-core assets. It's all about focus, which you need if you're going to hit that $1.5 billion productivity target.
Okay, and this brings us to the segment where we look past the immediate noise and try to find the structural opportunity.
And just to be very clear, this is not financial advice.
Absolutely not. But if you were trying to build a thesis here, the market is just completely obsessed with this IRA top-line headwind.
A top-line headwind that, again, management says is demonstrably profit neutral. The stock is being punished for an accounting optical illusion.
Meanwhile, the actual core thesis, the reason to own the stock, is not only intact, it's accelerating.
We just saw it, a 10% basket lift from Ask AI, 33 basis points of SG&A leverage. The AI-driven productivity engine is not a theory anymore. It's delivering results right now.
So here's the outrageous but plausible idea. It's a structural change long position.
You buy the shares here on this dip, making an explicit bet that the market's focus eventually has to shift. It has to move away from the temporary IRA noise.
And onto the real compounding bottom line success of that $1.5 billion productivity plan.
The rationale is all about the timeline. This dip to around $16 a share might be a chance to get in before that multi-year plan starts showing up in undeniable margin expansion in 26 and 27.
You're basically making a bet that technology and operational excellence will win out over retail competition and policy noise over a 2 to 3 year period.
Exactly. You're buying the stock while that $1.5 billion target is still being massively undervalued by the street. It's a classic bet on execution over headline fear.
So to just wrap the whole deep dive up, you have this clear divergence. On one hand, you have excellent internal execution. Digital is booming. AI is already working.
But that's running right up against these major external pressures, competition, and, this nonprofit hurting IRA policy that just drove the stock right off a cliff despite an EPS beat.
Management seems really confident in their algorithm for 2026, even with that massive 125 basis point headwind coming at them.
And that leaves the big question for you, the listener. With the aggressive cost cutting, the AI scaling, the SG&A leverage they're already getting, how many more quarters will it take?
How long until the market stops obsessing over a flawed sales metric and starts pricing the stock based on the higher margin, AI-driven bottom line that is already starting to show up?
That's the trade-off. And that's the story worth tracking.
We will be back next time with another deep dive into the earnings call noise. Thanks for listening.